If you've ever felt like your money disappears faster than it should, there's a reason. And ironically, it's the same reason a simple $35 a week habit can grow into more income than many full-time jobs. Time works against your paycheck, but it works for your investments. Once you understand that connection, everything else finally makes sense. In this video, I'm going to show you exactly what that means, how it affects your paycheck, and how weekly investing turns it around in your favor. We'll walk through real inflation pressure, how compounding works underneath all the chaos, and the list of Fidelity funds that keep growing even when the economy feels unpredictable. And at the end, I'll show you a Fidelity Index portfolio that can turn a $35 weekly investment into a portfolio worth close to $1 million and pays over $8,000 a month. But first, let's understand why weekly investing works better than one-time deposits in the real world. Most people hesitate with weekly investing because the amount feels too small to make a difference. $5 or $10 doesn't look like it could change anything. But that hesitation usually comes from the financial pressure people are already dealing with every single day. When your environment gets more expensive, faster than your paycheck grows, consistency, not size, becomes the thing that quietly works in your favor. You can see it clearly with something as basic as food. Since 2020, food prices climbed 3.45%, then 3.94%, then jumped a painful 9.95% in 2022, before slowing to 5.76% in 2023, 2.26% in 2024, and finally 2.45% in 2025. Put simply, the $20 of groceries you bought in 2020 now cost around $25.32 in 2025. That's not a statistic you forget. You feel it every time you shop. At the same time, borrowing money has gotten noticeably more expensive. The Federal Reserve's own data shows interest rates rising from near zero in 2020 to about 4.09% by late 2025, which makes mortgages, car loans, and credit cards feel heavier month after month. And while costs rise quickly, wages haven't kept up. The Economic Policy Institute's wage tracker shows year-over-year pay growth sitting around 3.8% in 2025. That's barely keeping up with short-term inflation and nowhere close to the total rise in prices we've seen since 2020. Then there's the stock market. The long-term crash timeline highlights every major drop, from the Great Depression to the dot-com collapse, the 2008 financial crisis, the COVID crash in 2020, and the inflation-driven decline in 2022. These moments always feel frightening in real time, but the charts make something else very clear. Every crash has eventually recovered, and the long-term trend still moves upward. Over the long run, the market still trends upward. Historical return data research consistently puts long-term market returns around 10 to 11% per year, including dividends. And this is why weekly investing is so powerful. You don't have to predict inflation, call market tops, or time dips. If prices rise, your weekly deposit still goes in. If they fall, you buy more at cheaper prices. If the market rebounds, you benefit automatically. In a world that constantly shifts, that steady little habit becomes one of the few financial moves you can rely on. And this is where the title of this video connects directly to real life. Because when the average paycheck grows around 3 to 4% a year, but a long-term portfolio often grows 2 to 3 times faster, your investments begin to build towards something your salary can never reach, eventually even reaching levels like $8,000 a month in passive income if you stay consistent long enough. When you look at those numbers, it becomes clear why long-term habits matter. But here's the part most people miss. Even tiny weekly amounts can create a snowball effect far bigger than you'd expect. The snowball effect becomes clear when you look at how even small weekly investing behaves in the first few years. Imagine someone putting in $20 every week. That's $1,040 per year, an amount so small most people barely think about it. In year one, the contribution is $1,040, and with normal market growth and reinvested dividends, the balance starts to move a little bit. Nothing dramatic yet, but the base of the snowball is forming. By year 3, total contributions reach $3,120, and with dividends reinvested and those early deposits getting time to grow, the balance could sit around $3,750. That extra amount, the part that didn't come from contributions, is the snowball starting to build. By year 5, total contributions reach $5,200, but the account may be closer to $6,850. Now the snowball has real weight. Each weekly deposit lands on a larger foundation, and every dividend buys more small pieces of ownership that create even more dividends. The first 5 years don't look explosive, but they build the groundwork that makes long-term growth possible. And at the end, I'll show you a Fidelity Index portfolio and how the snowball effect can turn a $35 weekly investment into a portfolio worth close to $1 million, one that pays over $8,000 a month. Understanding how that snowball forms is only half the story, because the mindset behind it matters just as much. Most people don't struggle with weekly investing because it's complicated. They struggle because the early results feel too small to take seriously. You put in $20, your balance moves a little, and your brain instantly wants to judge the progress. We're wired to expect quick wins, so when growth looks slow, it's easy to assume it isn't working. We also react emotionally to short-term market noise. A sudden drop feels alarming. A recession headline feels like a warning. A volatile week feels like a sign to pause. But these reactions come from linear thinking, expecting the market to move in neat, predictable lines. In reality, compounding builds in curves. Markets rise, fall, and shake around on the way up, and none of that shows up clearly in the early stages. The real mindset shift happens when you stop measuring success week by week and start measuring it by consistency. Instead of asking, "Is this growing fast enough?" the question becomes, "Did I invest this week?" That small shift removes the pressure to see instant progress and replaces it with a routine you can actually control. That consistency is what eventually allows your portfolio to grow bigger than your paycheck. Not because you outsmarted the market, but because you stayed steady long enough to let compounding do the heavy lifting. And once that mindset is in place, choosing the right investments becomes a lot easier. Choosing long-term investments becomes much easier when you understand what truly makes something worth holding. Instead of searching for the perfect pick, it's far more effective to look for a set of qualities that create stability and long-term growth. These criteria are exactly why the Fidelity funds in this portfolio work so well together. The first is diversification, which simply means owning a large number of companies instead of relying on just a few. When your portfolio holds hundreds or even thousands of businesses, no single failure can derail your progress. One company can struggle, another can shine, and overall, your growth stays steady. Broad index funds handle this automatically. You get wide coverage without the stress of choosing winners. The second is broad exposure, which is different from diversification. Exposure is about what kinds of companies you own. Markets rotate. Some years large caps lead, some years mid caps take over, and some years sustainable companies outperform traditional sectors. A strong long-term portfolio spreads exposure across company sizes, sectors, and styles, so you stay balanced no matter which area is leading. Next is real historical performance. You want investments backed by companies that have grown their earnings and strengthened their fundamentals over the years, not hype circles. Dividend growth is another key ingredient. When companies raise their dividends yearly, those increasing payouts buy more shares and make the compounding loop stronger. And finally, low fees matter. Even small fees add up over decades, so low and zero fee funds keep more of your returns working for you. When you put all these criteria together, you end up with a portfolio built to handle downturns, capture long-term growth, and compound steadily as time goes on. And that's exactly where these 5 Fidelity funds start to stand out. Each one checks the boxes you want, and together they cover everything a solid portfolio needs. The first one is FZROX, the Fidelity Zero Total Market Index Fund. This is the core of your portfolio, a simple, broad market fund that owns large, mid, and small cap companies across every major U.S. sector. Its purpose is straightforward: track the entire U.S. stock market with zero management fees. That alone makes it a strong foundation, but its performance strengthens the argument even more. It currently yields 1.04%, grows its dividends at 7.55% per year, and has delivered an impressive 13.5% annual price appreciation. FZROX lays the groundwork by covering the full U.S. market and building steady growth year after year. Then there's FSMDX, the Fidelity Mid-Cap Index Fund. Instead of focusing on the biggest companies, this fund invests in mid-sized businesses that are stable enough to be reliable, but still small enough to grow quickly. It typically holds around 300 companies spread across tech, industrials, consumer sectors, and finance. It carries moderate growth-oriented risk, and the performance backs that up. A 2.42% yield, a fast 17.21% dividend growth rate, and 7.4% annual appreciation. FSMDX adds the expansion phase of the market, companies that are still climbing. FITLX, the Fidelity U.S. Sustainability Index Fund, gives the portfolio a modern edge. It invests in companies screened for strong environmental, social, and governance practices, including many leaders in tech, healthcare, and communications. It's built for steady appreciation with exposure to companies shaping the future. FITLX yields 1.14%, grows dividends at 13.74%, and delivers 13.06% annual appreciation. It adds long-term resilience and growth from sectors that have shown strong momentum over the last decade. FGRIX, the Fidelity Growth and Income Portfolio, brings balance. It invests mostly in high-quality large-cap companies with stable earnings, giving you a mix of reliable dividend payers and consistent growers. Its design is simple: offer dependable income without giving up growth. The numbers match that intention, with a 3.13% yield, a very strong 19.68% dividend growth rate, and 8.17% annual appreciation. It supports the portfolio by lifting both sides, income and growth, at the same time. Finally, FDGFX, the Fidelity Dividend Growth Fund, is the income stabilizer. It focuses on companies with long histories of raising dividends and strong financial fundamentals. It leans towards safety and consistency rather than aggressive growth, which helps steady the portfolio when markets cool off. FDGFX yields 3.2%, grows dividends at 18.03%, and offers 2.78% annual appreciation. Its job isn't to race, it's to strengthen the compounding of dividend income year after year. The next step is to calculate the portfolio's metrics, starting with the dividend yield. Since we're keeping things simple, we'll use a basic average. First, we list out the dividend yields of each of the 5 funds: FZROX at 1.04%, FSMDX at 2.42%, FITLX at 1.14%, FGRIX at 3.13%, and FDGFX at 3.2%. Then we add them together: 1.04 plus 2.42 plus 1.14 plus 3.13 plus 3.2 gives a total of 10.93. Because we're treating each fund as an equal slice of the portfolio in this simple example, we divide that total by 5, the number of index funds in our portfolio. When you take 10.93 and divide it by 5, you get 2.186, which we round to 2.19%. That's how we arrive at an average portfolio dividend yield of 2.19% using a straightforward, equal-weighted approach. You can follow this exact same process to find the portfolio's average dividend growth rate and its average annual share price appreciation. Add up each fund's number, divide by 5, and you'll get the simple portfolio average. Using that method, this portfolio gives you a 15.24% average dividend growth rate and an 8.98% average annual share price appreciation, which is what we'll build on when we look at the future projections. Together, these numbers show a portfolio that not only increases its value, but also increases what it pays you over time. So let's take those strengths and see what they turn into over time with real projections. So let's look at Josh's example. He's contributing $5 per day, which adds up to $35 per week. And because the portfolio has 5 funds, that's basically $1 going into each fund every day. It's a tiny amount, the kind of money most people spend without thinking. But for Josh, showing up with that small daily habit is what turns it into something meaningful. By the end of year 1, Josh's total contributions would be about $1,825. This lays the groundwork for future growth and compounding. By year 10, the portfolio is projected to reach $32,000, with reinvested dividends starting to build real momentum. By year 20, Josh would have contributed $36,500 in total, and the long-term compounding will push his portfolio to about $160,000, generating nearly $9,000 per year in dividends. The final decade is where compounding really shows its strength. By year 30, Josh's portfolio is projected to reach $942,000, paying around $98,000 per year, or about $8,000 every month, in dividends alone. And once Josh reaches that 30-year mark, the breakdown will become even clearer. Over those 3 decades, he will have contributed a total of $54,750 out of his own pocket, but his portfolio multiplied it by 17 times to $942,000. Out of that future $942,000, subtracting his $54,750 in contributions leaves roughly $887,250 created entirely by compounding, reinvested dividends, and decades of steady market growth. That means the vast majority of Josh's future wealth won't come from what he paid in, it will come from the portfolio working for him. And that's the point where his investments will earn more than many full-time jobs, all because he stayed consistent with a tiny daily amount. If you could only invest in one index fund, just one, that has the potential to turn $10 into a $2.2 million portfolio and pay over $6 grand a month in dividend income? Click the video on your screen to find out which one it is.